Welcome back! Today, we dive into support and resistance, key concepts in technical analysis. These levels show where markets often change direction or pause. Understanding them is crucial for consistent trading success. Every pro studies support and resistance before making a trade. Without this knowledge, technical analysis is incomplete. This masterclass starts with basics and moves to advanced ideas. You'll learn how to spot strong levels on any chart. We'll cover different types of support and resistance, and 3 proven trading strategies. These tools help improve your entries and exits. Watch carefully as each part builds on the last. By the end, you'll confidently use support and resistance in real markets. Support and resistance are key concepts in trading that help us understand price movements. Before diving deeper, it's crucial to grasp what these terms really mean. Imagine the market price falling until buyers step in strongly. This buying pressure creates a floor, stopping the price from dropping further. This floor is called support, where demand grows and the market often reverses upward. It acts like a safety net for the price. Now, picture the price rising until sellers start taking profits or opening shorts. Their selling pressure creates a ceiling that limits further gains. This ceiling is known as resistance, where supply outweighs demand and the price often turns downward. It acts as a barrier to rising prices. Support and resistance aren't exact lines but zones of strong buying or selling. The more the market respects these zones, the more useful they become for trading decisions. Support and resistance are key levels where the market often reacts. Understanding why price reverses at these points is essential for traders. When price nears strong support, buyers see a chance to enter. Increased demand slows the fall and often pushes price up. At resistance, sellers take profits or open shorts. This selling pressure usually causes price to reverse downward. Support and resistance are unbreakable barriers. Strong buying can push price above resistance, creating a breakout. Likewise, heavy selling can break support, leading to a breakdown. These moves often mark the start of new trends. Knowing when levels will hold or break is a vital trading skill. This masterclass will guide you to master it step by step. Support and resistance are key concepts in trading that show where price reversals happen. Knowing how to draw them correctly is essential to avoid common beginner mistakes. Resistance forms when price rises and then sharply reverses downward. Support appears when price falls and then bounces back up. Use the rectangle tool on your chart to mark these zones instead of single lines. This captures the full price range where buyers or sellers are active. Support and resistance are zones, not exact prices. The market often moves slightly beyond these areas before reversing, which is normal. Focus on the entire reaction zone, not just one candle. The more times price reacts within a zone, the stronger and more reliable it becomes. Mastering how to identify these zones improves your trading setups. Accurate support and resistance zones help you make better decisions and trade with confidence. Support and resistance are key to understanding price action. Knowing their types helps predict future market moves. Fixed support and resistance are classic horizontal levels. They form at significant swing highs or lows where price reverses. When price hits a level and turns down, that's fixed resistance. If it falls and then bounces up, that's fixed support. These levels stay at the same price until a new market structure forms. Traders watch them closely because price often reacts there again. Revisiting fixed zones shows how buyers and sellers behave. Strong reactions here reveal clues about the next market move. Recognizing these patterns helps spot high-probability trades. Mastering fixed support and resistance sharpens your trading edge. Support and resistance can be found using the day high and day low. These levels are key for intraday traders watching price action closely. Imagine the market rises to its highest point before dropping. This peak is the day high and often acts as strong resistance. When price returns to the day high, selling pressure usually increases. This makes it harder for the market to push higher. Now picture the market falling to its lowest point before climbing back up. This low is the day low and typically serves as solid support. When price revisits the day low, buyers tend to step in. This can create demand and trigger another upward move. These levels don't guarantee reversals but mark where traders get active. Professionals always watch the day high and low before trading. Psychological levels are key support and resistance points at round numbers. Traders and institutions focus on these levels, causing strong market reactions. For example, prices near 46,500, 47,000, or 48,000 often act as major zones. This applies to stocks, Forex, crypto, and commodities worldwide. Why do these levels matter? Because many market participants think alike and use round numbers as guides. Institutions, retail traders, and algorithms set entries, exits, and stops around these points. This boosts trading volume and significance at these levels. If the price nears 47,000 and selling pressure rises, the market may drop. But if buyers push above it, the level can become new support. Professional traders never ignore psychological levels. They combine them with other tools to find strong trading opportunities. Support and resistance levels show where price might turn, but trading just because price hits these levels is risky. Professional traders wait for confirmation before acting. This helps avoid false signals and bad trades. At resistance, watch for bearish candlestick patterns like shooting star or bearish engulfing. These suggest sellers are entering the market. Don't enter immediately. Wait for the next candle to close below the bearish pattern's low. This extra step confirms the signal and improves trade success. Add support. Look for bullish reversal candles like hammer or bullish engulfing. Then wait for the next candle to close above the pattern's high. This confirmation shows buyers are in control and strengthens your trade decision. Support and resistance guide you, but candlestick confirmation tells you when to act. Let's explore a strategy using multiple candlesticks at key support or resistance zones. This reveals market strength and the moves of big players. Picture price hitting strong resistance with several bullish candles appearing. It might look like buyers will break through, but don't jump in yet. If those bullish candles can't break resistance, it means sellers are absorbing the buying pressure. The market struggles to move higher despite aggressive buying. Wait for a strong bearish candle confirming rejection at resistance. This often signals a good chance for a short trade. The same applies at support with bearish candles failing to push price lower. A strong bullish candle after this shows buyers stepping in. The key is not to judge by candle color alone. Watch how price acts around support and resistance for better trade decisions. The third strategy is popular among traders. Wait for a retest before entering a breakout trade. This confirms if the move is real or just a pause. Imagine price hits resistance and pulls back briefly. Many rush to short, thinking the breakout failed. But this pullback is often profit-taking. Wait for price to rise and close above resistance. This confirms the breakout and turns resistance into support. The same applies to breakdowns. If price bounces off support, don't assume the downtrend ended. Wait for a break below and close under support. Successful trading means waiting for strong confirmations. Use support, resistance, patterns, and retests to avoid mistakes.